Hello and welcome back to the channel. I'm Sam, and in today's video we'll explore how to accurately identify market trends. But before we get started, we just want to take a moment to thank you for your continued support. Subscribing to our channel helps us keep creating valuable educational content for you. When it comes to trading the financial markets, there are two main ways people approach it: fundamental analysis and technical analysis. Fundamental analysis looks at the big picture, things like economic data, politics, and global events that impact a country's currency. On the flip side, technical analysis is all about the charts. It focuses on price action to figure out when a new trend is starting. Both methods aim to spot trends, but when it comes to timing, technical analysis takes the win. So where should beginners start? Try experimenting with the moving average. It's one of the simplest and most useful tools out there. Just add it to your chart and observe. 1. If the price is above the moving average, you're likely in an uptrend. 2. If it's below, that's a downtrend. Simple, right? Another popular method traders use is oscillators. These tools help with three things: spotting trends, identifying overbought or oversold conditions, and catching divergences between price and momentum. For example, when an oscillator crosses above its baseline, it usually signals an uptrend. When it dips below, it points to a downtrend. Take the MACD, for example. If it crosses above the zero line, it's a no-brainer. We're likely looking at an uptrend. If it crosses below, that's a sign of downward momentum. And voila! Right, now let's move beyond indicators and look at the price itself. According to Charles Dow, that's right, the guy behind the Dow theory, an uptrend is made up of two consecutive higher tops and higher bottoms. The trend is confirmed when the price breaks above the second top. And guess what? This is the perfect time to bring back your moving average and MACD for extra confirmation. When all three line up, you've got a stronger case to pull the trigger. The same logic applies for a downtrend: two lower tops and lower bottoms confirmed once the price drops below the second bottom. Again, use your favorite indicators to filter out the noise and build confidence. For those with a bit more experience and need faster signals, double tops and double bottoms are solid chart patterns to look out for. Say you've been in a downtrend. Suddenly the price forms two bottoms. If the second one stays above the first and the price breaks above the top between them, it signals a bullish reversal. Filter with the moving average and MACD for backup, just like before. Now, flip it. After a strong uptrend, if the market forms two tops and the second doesn't beat the first, a break below the bottom between them suggests a downtrend is on the way. Again, combine this with your go-to tools to boost confidence before entering a trade. Thank you for watching. If you have any questions, drop them down below and we'll be happy to answer. Don't forget to like, subscribe, and tap that notification bell so you never miss an update. See you in the next video.
FXGT.com. Trade your way, experience the difference.